What's good, CEOs? It's your boy CEO Sean. We back at it again for another video for the third part of the Strap Basic series that I want to cover. So are you tired of getting stopped out of your trading positions that you should end up winning, right? You get stopped out of a trade and then end up reversing, and then it's like, dang, I just missed out on all this profit that I could have made had I not gotten stopped out of the trade or had I still been in the position, right? So in this video, we're going to be covering a trading phenomenon that will teach you the skill to avoid this trading mistake in your trading. So let's get into it. Right? So the answer to the reason why you're getting stopped out of your positions is called price discovery broadening formations, right? Price discovery broadening formations. That's what we're going to get into, right? So the reason I said price discovery broadening formations is because price wants to discover new highs and new lows, right? So as you can see right here, we have a low and we have a high. Price ends up going lower and creates a lower low because this low right here is lower than the previous low, right? That's a lower low. This high is higher than the previous high. That makes this a higher high. So price wants to discover new highs and new lows to create this broadening or expanding pattern. So you might be thinking to yourself, okay, so Ashawn, why would price want to discover new highs and new lows? Like, what does discover new highs and new lows even mean, right? So I completely understand that. Let's get into it, right? So I'm gonna use a real world example. Like, I know a lot of traders, we like to teach and connect it to the market, but I want to teach it from the perspective of something that you already understand, right? So let's just give an example. Let's say you have $10,000. You can either choose to buy this thing that I'm going to uncover for $10,000, or you can sell it for $10,000, right? So you can either buy it for $10,000 if you think it's cheap, or you can sell it for $10,000 if you think it's expensive, right? So let's move this real quick. So would you buy or sell a Lamborghini Revuelto? Right? Would you buy or sell it? I don't know if I'm saying that right, but would you buy or sell it? Would you buy it for $10,000, or would you sell it at $10,000 and for like $10,000? Like, would you sell this car for $10,000? Obviously, you would probably pick buy, right? If it was a like no gimmicks, no nothing, brand new, like brand spanking new, nothing's wrong with the car, you would buy that thing for $10,000 hands down. Why? Because you could just buy it for $10,000. Right, and then sell it for $604,000 because it's literally brand new 2024 Lamborghini car, right? So it's brand new. So you can literally you can either buy it for $10,000, keep it for yourself, or you can buy it and sell it and make $600,000, basically $600,000, right, in profit, right? So you would buy this for $10,000. Now let me ask you this: would you buy or sell a MacBook for $10,000, or would you sell it for $10,000? Would you buy it for $10,000 or sell it? Most people will probably pick, I'm gonna sell it. I don't want to buy it for $10,000. So if I had to pick, I'd rather sell it for $10,000, right? To someone who's willing to pay $10,000 for a MacBook, right? And then you'd buy it back for, let's just say $1,000 or $1,100, or let's say $2,000, $3,000 max, right? So you would sell it for $10,000, buy it back for, let's just say $2,000. You make an $8,000 difference on that because you got the MacBook, right? You sold it for $10,000, and then you bought the same exact brand new MacBook for $2,000 because you know the actual value of it is $2,000, $1,000, $1,500 for a MacBook, right? You know the value of it. So the reason you made these decisions is because there's two things apparent, like the reason you made that decision. People buy and sell things based on the value, not the price. So the reason you pick two different answers with the same price point of $10,000 based on the underlying value of the thing that you're either going to buy or sell. Number two, people always want to buy at a discount and always want to sell at a premium. What does that mean? I want to buy something for $1 and sell it for $2 every single time, hands down, every single time. Like any marketplace, I don't care what marketplace you in. I'll buy a fidget spinner for $1 and sell it for $2. I want to buy, let's say you selling candy at school. I'm gonna buy a candy for $1. I'm gonna sell it for $2. Let's use it for like MacBook, for example. I'm gonna buy a MacBook for $1,000, sell it for $2,000. I'm gonna buy a car for $100,000, sell it for $200,000. Like whatever, any marketplace. Literally, find a marketplace. That's your homework. Find a marketplace for me that doesn't work. I'm pretty sure you're not going to find one, right? Buy something for cheaper, sell it for a higher price. Sell something at a higher price, buy it back for cheaper. That's how everything works. Lambo, MacBook, trading options, trading futures, it's the same thing. So if you can decide the market value of a Lamborghini Revuelto and a MacBook and decide whether or not to buy or sell it based on the underlying value of those assets, then you can figure out the underlying asset of options and futures and be able to trade that as well. So you still might be thinking, okay, I get it. You're still probably thinking like, what does this have to do with my stop losses and getting taken out of positions? Let me get into it, right? So first thing I want to cover is, the next thing I want to cover is buyer and seller mentality, because I want you to understand the buying and selling mentality that goes into the market, right? So let's just say price is at $100 and then it goes up to $150. Sellers want to sell at a high price. There's three things that sellers want to do all the time and buyers want to do all the time. So they all have three things that they need to do. I like to look at it like the three plates you get at Old Country Buffet, or the buffet you go to where you're getting three plates. The first plate, you're going to put everything on. Second plate, you're going to put a lot of stuff on. And then third plate, you're probably going to get your dessert. After that, you're going to be full. Let's get into those three plates. The first plate, they want to get in at the high. So sellers, boom, they want to get in at the high, right? So at 150, if they say, all right, 150 is really high or it's overvalued, bet we're going to start loading up sell positions or loading up puts, like if you trade options, and betting on this thing to go down. Number two, they want price to go lower. I'm pretty sure no one is going to sell something or buy puts if you don't want it to go lower. If you ever bought puts and said, I want price to go higher, then I'm worried for you a lot. I'm worried for you because like that's not how you make money, right? Number three, buy back at the lowest price possible, right? So they want to sell it or buy puts at $150 and then buy it back at $80. So if they sold it, the asset, whatever it is, a stock, it could be anything. It could be a stock, it could be futures, it could be whatever it is. They sell it for $150, they buy it back for $80. Guess what they profit between selling it for $150, buying it back for $80? They make $70 in profit. That's how sellers make money. So once they get these three plates, first plate, second plate, third plate at the Old Country Buffet, boom, they full. They're tired. They ate all the food and they done. They're done for the day, right? So because they're full, they'll start to get complacent. They'll start to get reckless. They'll start to get sluggish. They'll start to get like they just relax. This is where buyers step in so they can get their plates, right? So here's the three plates for buyers. Buyers, they want to get in at a low. So price is now $80 and it was previously at $100. I'm going to load up at $80 so it can at least go to $100 and then probably go to $150 and then probably go higher than that. So they want to buy at the low. Number two, they want price to go higher. I'm pretty sure if you ever bought something for $1, you didn't say to yourself, I want this thing to be worth 50 cents. I want this thing to be worth 25 cents. You want it to be worth more over a time, right? So that's the buying mentality. Number three, they sell it. I said buyback, but I meant sell it at a higher price. So they bought it at $80. They sold it at $200. That is a difference of $120. They buy it for $1, sell it for $2. They buy it for $80. They sell it at $200. They make the profit on that. So that's the tandem that goes back and forth between sellers and buyers. Sellers want to sell at a high. Buyers want to buy back at a low. That is just how buyers and sellers work, right? That's how they work. So now the next thing I wanted to get into, because you might be thinking, well, what does this have to do with me getting stopped out of my position? You've probably entered a position where you probably sell the market, run it up or something like that. And then you look to get into, let's say, buy position. Then after you get into a buy position, your trade gets stopped out. Boom. You get stopped out of your trade. You take a loss. And then literally right after you get stopped out of your trade, price sets up for a reversal. And then it just starts going in the direction that you literally were in for. Like you were betting on it going up. You got stopped out of your buy position. And then it started going up. If this has happened, just comment in the chat like, yo, this happened to me before, right? And I don't want it to happen anymore, right? So this is what's happening to you. You enter the trade, price pulls back, you get stopped out, and then price sets up for a reversal and then bow. You missed out on profit or you got stopped out of a trade and didn't get a re-entry, right? So you missed out on a bag again. I'm telling you from personal experience, I've been through this exact same thing before. I get stopped. I still get stopped out of some trades. But what I do is I make sure if I get stopped out, I pay attention to see, okay, is price taking out a low for buyers to step into the market? Is price taking out a high for sellers to step into the market? I ask these questions now because I understand the market moves in broadening price discovery patterns, right? The price overall wants to take out highs and take out lows, right? And I'll show you other examples of what that looks like in the market, right? But broadening formations is higher highs and higher lows. That's it. So your homework, I literally want you to go look at your previous trades where you got stopped out of a position. And I literally want you to see, if price took you out and then set up for a strat combination and reverse afterwards. This is a strat combination right here. Price stopped you out your trade for a 2 down, inside candle, 2 up reversal. So literally after it stops you out, buyer steps into the market, 2-1-2 reversal, and then boom. Buyers started stepping into the market aggressively and they started pushing price higher. That's what happens. That's what happens, right? So here's what it looks like. So like when I said strat combinations, right? So remember on episode, I said episode 1, like this is a TV show, right? But remember on the YouTube video where I was talking about actionable signals, right? Easy as 1, 2, 3, right? If you haven't watched that video, go check it out, right? There's only 3 types of actionable signals that happen in the market. There's only 3. There's only 3 that happen in the market. There's 1s, which are inside candles. There's 2s, which are directional candles. And then there's 3s, which are outside candles, right? 3s are broadening formations on a higher time frame. So this is just a strat combination just to show you reference, right? This is an inside candle, and then price, it comes down, takes out the low of this inside candle, and then buyers step into the market and start pushing price higher again, creating this bullish outside candle. Price takes out the low and then goes to take out the high, right? And I also demonstrated right here. So this is the inside candle, for example, or the 2 candle, whatever candle it was previously. It took out the low of that previous candle, and then buyers started stepping into the market and they push price higher to take out the high of that previous candle. And the opposite for a bearish outside candle too. Price takes out the high, sellers step into the market, boom, they push price and they take out the low of the previous candle, creating an outside bar, right? So let me show you an example. Like literally, you might be thinking, well, what does that even mean? 3s are a broadening formation on a higher time frame, right? So look, what does price do for this 3 candle? This is a 3. Price takes out a low, and then price takes out a high. What does price do right here? Price takes out like literally comes up, takes out a high, comes down, takes out a low, and then comes back up and takes out a high again. Price takes out the low, then takes out the high. That's literally, so if your stop losses are right here, you're getting stopped out of your position, and then price is literally going and targeting, creating an outside bar, aka it's targeting expansion. The market wants to expand. Buyers want to get in at a low. So where you, watch this, where you got stopped out of your position, buyers got into their position. So your stop loss was in order for buyers to get filled. Because guess what? How do you exit anything that you buy? In a buy transaction, how do you exit it? In order to exit something that you bought, you have to sell it. I bought something for $1. My goal is I want to sell it for $2. But if I sell it for 50 cents, I still am selling it. I'm exiting buy sell. But it's about, am I selling it higher than what I'm buying it for? Right? But I still have to sell it. So if you had buys or you had a buy position, right? In order to exit that buy position, you have to sell. So guess what that sell order is? In order for me to buy anything, it has to be sold to me. So your sell order, aka your stop loss, is the sale for me, a buyer, to enter the trade into where you had your stop loss at. Because you had your stop loss triggered. Meaning you sold your position to somebody. Your stop loss literally is a sell order, meaning that you're selling your position to the market, right? Somebody is buying your stop loss. So where you lost, somebody else is entering their position to win. I want you to think about that next time. So whenever you get stopped out, I want you to pay attention to what the market does right after you get stopped out. Because if you're getting stopped out and then buyers start stepping into the market, that means that buyers are most likely loading up orders and they're loading up positions at that low or at that area where your stop loss got triggered. So they can load up at the what? Let me show you. Let me go back to it. So you can load up at $80 for price to then go to $200. Price was up here at 150, came down to 180. Boom. You got stopped out of your position at 100, but they started loading up their position at 100, 90, 80, and then price started shooting up to 200. That's how they make their money. That's literally what, is that not what happened right here? Boom, price is at 100, 150, price came down here to 80, boom, price then went all the way up here to 200. That's exactly what happens, right? That's what happens in the market. So let me show you like what this looks like on an actual chart, and then hopefully this helps you out, right? So let me show you something real quick. So I want you to start paying attention to candles like this is the daily time frame, and then this is the hourly time frame, right? So I want you to pay attention to this real quick. So as you can see, I created these squares to highlight the start of the day for Wednesday, right? For Wednesday, going into, not Wednesday, Thursday, right? This is Thursday. Yep, Thursday. So this is Thursday. This candle represents price going up, creating this high. As you can see, this is lined up. This is the high, and price comes all the way down here and creates this low. This candle represents Thursday. This candle represents Friday. This candle, I know it looks a little bit bigger. This is representing Sunday, Monday, and then this candle represents Tuesday, right? And going into Wednesday, right? But as you can see, what does price do? Price comes, takes out the high of this previous candle. So if I mark this out, price comes and takes out the high. I'll mark this out as the low. So this is the green line is the high, red line is the low. Price comes and takes out the high and then comes down and takes out the low, creating a broadening formation pattern. Right? Why is this broadening formation? What is broadening formations? Higher highs and higher lows. Price created a higher high, came down to create a lower low. And now price is probably going to set up to create a higher high again, right? Most likely, price just likes going up. Like people just like buying and going up. People are greedy, right? But this is literally what broadening formations represent, right? So let me show you another example, right? Because this happens so much in the market, you literally wouldn't even realize it. It's crazy. So if I go over here, let me remove these off the chart, just so I don't have a whole bunch of lows on my chart. Let me mark out this right here. So let's mark out this high. And then let's mark out this low from this previous day, right? If we go over here, this was the high. So this is a bullish candle. So price opened up right here, right? Came down, indicated by this wick. Then we came back up. And then we ended the day at a high of, what is that? 53.47.50, right? On this particular day, on Tuesday, this was Tuesday, right? Yep, Tuesday, we ended the day at a high of 53.47.50. The next day opened up on Wednesday, and what did price do? Price came up, took out that previous high, aka created a higher high, and I can demonstrate that by doing this high to a higher high, right? Price created a higher high, and then what did price do? Literally right after it created a high. What did it do right after it created a high? What did it do? It did a 3. Price did a 2 up. It failed 2 up, by the way. Why? Because price took out the high and then closed as a bearish candle. That is a failed 2 up. Why? Because it failed to do its job. It's 2 up, meaning it's supposed to be going up. If it went up and it went down, that means sellers are starting to gain control. That's a failed 2 down. So this is a 3, 2 up, 2 down reversal. You might be thinking like, what is a 3, 2, 2? I'll pull up the strat numbers for all the new people that's here. Like, yo, what is the strat numbers? If you type in candle type, the strat, it'll pull up the indicator for you to highlight what type of candle that it is, right? So this is a 3, 2 up, 2 down reversal. Let me just show you, I'm not lying. Let me go over here to the strat combo sheet, right? What do I see? We have a 3, we have a 2 up, followed by a 2 down. We're going to enter here, and then we're going to target the bottom of the 3 as our first target, right? That's the actionable signal. We go back to the chart. What do I see? A 3, 2 up, 2 down. So we can enter the position right here. Let me do this real quick. Let me move this down real quick. Short position right here. We can enter a short position right here. And then if we want, we have our stop loss at the high. And guess what we can target? And this is so beautiful too, because all the breakout traders, like if you're trying to break out like, oh, price broke above this high, so bet we're going to the upside, and then you start getting buys. You're getting cooked here. So if you bought right here, boom, you bought, and then sellers stepped in the market and they started getting their positions filled. Their sell orders got filled, and they started getting aggressive at this high. Why? Because sellers want to sell at a high and buyers want to buy at a low. Let me show you how apparent that is. Price took out a high, seller stepped in the market. Indicated literally by this candlestick right here. Price broke above the high, created a huge wick. So that means that buyers pushed price up here. Seller said, pushed it back down and said, pushed it down even further. And then said, And then it took it back down and took out this previous low right here. So if your stop loss was right here for buys, boom, you got took out. And then price reversed on you. And it came all the way down here. And guess what price targeted? This low to create a bearish outside day. It targeted this low right here. So it created a 3. Took out the high, of the previous range and then took out the low of the previous range. So you can literally go and target this previous range as a target. What did price do? Took out the high, took out the low. Broadening formations. Connect these. You don't worry about these lines. Just worry about, is price creating higher highs and higher lows? And you can connect a high to a higher high, price will be pointed up. If you connect a low to a lower low, price will be going down and pointing down. Right? That's all it is. That's what these patterns represent. So I want you to understand, this is why you're getting stopped out of your positions. What you're doing is, if you're getting stopped out, your stop loss or your exit position is an entry position for somebody else. So I want you to pay attention to the sentiment of the market, because broad informations happen so much. Let me show you another thing. Literally the next day, what did price do the next day? Let me mark out the high of this day. This is the high of this day on Wednesday. Let's mark out the low. What is the low? This is the low right there. This is the high, the highest point of the day. This is the lowest point of the day, right? What did price do? Price went up, took out the high of the previous day, right? Took out the high, reversed. And then what did it set up for, right? We set up for a reversal right here, 2-2 reversal right here. So you could have entered the position right here. Let's say you enter the position right here. Boom, stop loss right here. What does the strat combination say? 2-2 reversal, 2 up, 2 down reversal. We enter here. First profit target is going to be this first candle right here. Let's go back to the chart. Boom. My entry's right here. What's my first target going to be? Right here. Initial candle right here. That's going to be my first target. So boom. I'll take profit at this level. And then what I like to do is I like to move my stop loss to break even so I can't lose on the trade. Right? So I took profit right here. I don't lose on the position. Boom. Price ends up reversing. And then I get stopped out at break even after I already took profit. Okay, that's cool. Right? But here's the thing I know. Sellers are trying to get their position filled somewhere up in this junk right here. They trying to get their position filled. So watch this right here. We see another 2 up, 2 down reversal, right? 2 up, 2 down, bearish reversal. So guess what I'm going to do? I'm going to enter this position short at the low of this 2 up candle, the low of this 2 up candle, and guess what I'm going to target? The low of the first candle. The low of the first candle. So I'll target that. I'll take some profit around there. Guess what? Move my stop loss to break even. Does price ever come back to that level? Nope. And guess what price is going to? Guess what price did? It fell down. And guess where price ended up taking out? The previous low of the previous day. This is the high. It took out the high, came back down, took out the low. Created an outside bar. Price expanded. Took out the high, took out the low, price expanded. So everybody that's buying here, that's trying to push the market up. So if you had a buy position here, boom, you got cut out of your position. Because because sellers are trying to get in the market right here, as you can see. Buyers try to step in the market, boom, sellers get in. Buyers try to push it up a little bit more. Sellers saying, we ain't having that. And sellers push price down, and then we take out this low. That's what we do. That's how the market works. Buyers want to buy it at a cheaper price. You want to buy it at a cheap price. When I asked you, would you buy the Lamborghini Revelto for $10,000? You said, bet. Give me that thing for $10,000 because you know the value of it and you know that inherent to the actual value of it, you're getting it for a discount. Right? Understand, if you want to get stopped out of less of your positions, or at least be able to understand what the market is doing, so you can either re-enter those positions if you want to, so you don't lose out on money, or at least catch the profit, then understand, what do sellers want to do, what do buyers want to do in correlation to the market. Because outside bars happen all the time. And I know what you're probably thinking. You're probably thinking, Sean, this don't happen all the time. The market typically trends in an upward direction. But I'm so glad you said that, and I actually had something prepared for you. Let's go back to the pandemic. If we go back to the pandemic, let's go back to 2020. Pandemic happened around March. What did we do? Price came up, took out a high, and then price came down and took out a low. We created a broadening formation during the pandemic. So everybody that's selling right here, price took out this low, and guess what happened? Buyer said, we loading up positions right here. We loading the boat. Indicated literally by what? What happened? Sellers pushed price down. Buyer said, They pushed it back up. Then said, again. Pushed it even higher. And then they said, they created an outside bar, a bullish outside candle, a bullish outside bar. And then what did price do? Price shot up after that. And guess where the target is going to be this high right here so we can expand to the upside again. Even during, that's a recession. Shoot, broad information is your recessionary tool right there. Like if price takes out a low, look for a reversal on the weekly time frame to look for some buy. That's a little like Jim, write that down, please. Because you can see these are the previous look at the previous pandemic. Let's go back to 2008. Let's go back to 2008. There was a session in 2008. What happened in 2008? Let's see. If I... Oh, this is even beautiful. This is even more beautiful. Look at this. We got a... Look at this. We got a high. We got a higher high. This is a low. We got a lower low. Ain't that beautiful how that worked? Price took out a high, then came down and took out a low during a recession, and then came back and took out a high again, and then price started to fly to the upside. And then even price right here. Look at what did price do right here? Boom. This is a high. Higher high. This is a low. Lower low. So guess what? There's people that got their buy orders right here. You probably got your buy positions right here. Boom. You probably got your, no, not your buy position, your stop losses right here. So you might have entered buys. Price came down. Boom. Came down, stopped you out position. Guess what happened literally right after it stopped you out position? 2, 1, 2 reversal to the upside. 2 down, inside candle, 2 up reversal. And then eventually price ended up going to the upside again and then going to take out what? This high right here. It happens too often in the market, bruh. It happens too often. Price, here's the thing. People are like in nature, like you see, if we zoom out on a big level, people are greedy. People want price to go higher over time, but they're not that stupid to the point where they're just gonna buy at the most expensive price. Like they'd still rather buy at the cheapest price possible. That's just human nature. Humans, people, us, traders, investors, still want to buy for $1 and sell it for $2. They still want to buy at the cheapest price. So when you get stopped out, they're loading up their positions so they can load up here so they can push price higher and then they can get a crazy return on their money. These pullbacks happen so they can get their positions filled. And broad information don't always look pretty, like right here. This is the broad information right here. This low created this low right here. This high created this high. This is a higher high. Price after that came down, took out this low, kept going. After it took out this low, we started seeing some activity. Then it chopped around right here. Price came down, took out that low again, like literally going off that broad information. And then we had a inside candle, 2 down, 2 up reversal, and then boom, price shot up after that. What did it do? Took out the high. Price literally takes out lows and then takes out highs. That's what it does. Took out a low right here. Then price came, took out the high right here. Boom. We swept that low, swept all these lows. Buyers started stepping into the market. We also swept this low right here. Buyer stepped into the market, pushed price higher, swept all these sellers right here. That's how the market works, bro. That's how the market works. So again, if you get stopped out of your positions, like this is why I covered the 3 videos that I had. The actionable signals, I talked about time frame continuity in this video, and I talked about broad information in this specific video, right? I don't want you to be this. This is you right here. This is you. You're begging for help. You're inside the mouth of Pac-Man. But instead of being this person, why not be Pac-Man? Why not be lower lows and higher highs? Lower lows, higher highs. Getting in at the low, selling at the high. Getting in at the low, selling at the high. Why not be Pac-Man instead of being the one getting beaten up and eaten up and swallowed and devoured and waka waka by Pac-Man? Why? The choice is yours. The choice is yours. At the end of the day, you can either decide to be helpless or be the help. Right? The choice is yours. Right? I hope this video was helpful. I hope you learned a couple things about broad information. I'm definitely going to do more videos. If you have any questions, comments, or concerns, put them in the description of this video. If you like this video, make sure you like and subscribe, and I'll see you guys in the next video. Again, please put your questions and concerns in the description. I'm going to make sure that I create videos covering every single question that you have because I want you guys to understand how the market works, how you can leverage the market to make money and print money for you so you can start building wealth in your family. Let's get it.